This is how you manage your money and how you should structure your portfolio to ensure long-term and consistent success. So this is our spreadsheet that we're going to be working from today. You can get a copy of this spreadsheet for free. The link is in the description. And it's very, very simple. It's a dynamic spreadsheet, and the way it works is you enter in the size of your portfolio. So we're just going to be basing this on a $100,000 account. And then you also want to enter in whatever the current VIX level is. So we're just going to pretend that the VIX is at 23.1, and then everything is going to be calculated for you. This spreadsheet is geared towards selling options contracts. Okay, that's what we do at EDS. That's what we do on this channel. We sell options contracts, and this spreadsheet is going to tell you exactly how you need to structure your portfolio. So if we go down the list, it tells you the percentage of the total amount of your portfolio that you should be allocating to short premium. So, and then below it tells you in dollar terms. So if you have a $100,000 account and the VIX was at 23.1, you should be allocating $35,000 to short premium strategies. So that's things like short strangles, puts, calls, spreads, etc. And in this example portfolio, the minimum amount of your portfolio to allocate to undefined risk trades is $26,250. Okay, so at least $26,250 of your portfolio should be allocated to strangles, puts, and calls, naked positions, or undefined positions, and then the maximum amount of your portfolio that you should be allocating to defined risk trades like iron condors and spreads should be $8,750. So no more than $8,750 for defined, and a minimum of $26,250 for undefined. So you want to weight your positions far more heavily towards undefined risk trades. This is simply because with undefined risk trades you can manage them a lot better. You have a higher probability of profit, and it's going to ensure smoother returns or a smoother P&L curve. And then we have some position by position metrics. So the maximum amount of buying power that you should be allocating to a single undefined risk position is $7,000. The maximum amount of buying power to allocate to a single a defined risk position is $5,000. So $7,000 for undefined, $5,000 for defined. That's the maximum in this example portfolio. Obviously, you don't need to, spend $5,000 or $7,000 on every position. This is just the maximum. Okay, and there's also an explanation here going through what you need to do, and there's also a VIX level and max portfolio allocation chart here. Like I said, this spreadsheet is in the description. It's completely for free, and now I'm going to show you what this actually looks like when it comes to implementing these metrics in your trade. So we're just gonna sell some naked positions, say a short strangle, and as you can see in this example portfolio, the minimum amount to allocate is $26,000, and for per position we can allocate no more than $7,000. So without further ado, let's just jump into our broker platform. $7,000 is our maximum per position. Okay, so what you want to do is just pull up a list of underlyings to trade. We're using futures. I strongly recommend futures as your starting point. When you've run out of things to trade on futures, then look at equities. Futures is going to give you a way higher return on your money. It's far more capital efficient. It uses span margin as opposed to just using the normal way of calculating buying power, which is how it's done with equities. So you want to just go down the list, see what would fit well in your portfolio. We're going to assume you've got nothing in your portfolio, so you can pick anything you like. And we're going to just have a look at ZB, which is a 30-year Treasury bonds. It has an IV rank of 52.4 and an absolute IV level of 11%. Okay, so when you are looking for trades to enter, you want to make sure you have IV rank on your watch list, and you only want to be looking at things to trade with an IV rank of at least 30. Anything over 30 is high, over 50 is very high. I like to be in the mid to high range, so 52 is quite nice. So once you've selected your underlying, you want to then select a expiration date. So you want to pick one that's between 30 and 60 days out in time, and you want it to be a monthly expiration date. So there's one here, 46 days out, April 25th. So we're going to open that up. 45 days is perfect, but anywhere between 30 and 60 is fine. And now we're just simply going to set the trade up. We're going to sell a strangle. We're going to do what we always do, sell a strangle, 15 to 20 deltas out on either side. So let's just do that now. We've got a 17 delta here at the 1, 2, 3 strike, and we have a 16 delta at the 1, 1, 3 strike here. So as you can see, both of these contracts are outside the expected move. They are sitting against our 1 standard deviation levels, and this is going to lead to a very high probability trade. So if we look in the bottom corner, we have a pop, which is probability of profit of 79%, which is nice and high, and that's if we hold till expiration. If we want to get out 50% of max profit, then we'll be able to do so with probabilities 10 to 15% higher than your pop. It's not displayed for futures, but for equities it is. It's about 10 to 15% higher. So the longest I will hold a trade is to 50% of max profit. So our P50 number in this case is going to be around 90%. So we've got a 90% chance of success on this position here. If we get out 50%, you can get out earlier, say 25%, and that's going to boost your win rate up to about 95%, maybe a little bit higher. But you're looking at about 90% win rate on this position here. We're going to get $27 of positive daily theta decay. This is going to become more and more aggressive as we get closer to expiration. And we're going to collect $906 upfront. That's going to get added to our cash balance, and we're going to collect that upfront as soon as the trade gets filled. It's going to be done automatically by a broker, and this is where our position sizing comes in. So our buying power requirement is going to be $4,163 in this instance. And if we go back to our template, we can see here that the maximum amount of buying power to allocate to a single undefined risk position is $7,000, and in this instance we only need to use 4,000. So this position would fit well in this example portfolio that we're looking at. Okay, now you might be thinking $4,000, maybe that's too much for you. Maybe you have a smaller account. So let's just change the numbers a little bit. So let's change this to say $25,000. Well, now all of a sudden, 1,750 is the maximum for undefined risk position, and so this position would not fit in your portfolio. As obviously your buying power requirement is too large. Now you can just turn this into an iron condor or something like that if you really wanted to reduce your buying power requirement and kind of force the position to fit inside your portfolio. But before you do that, I would try and stay undefined as much as possible. So you might be wondering, well, how can you reduce your buying power requirement with futures? You can just go further out of the money. Although this is not necessarily recommended, it will reduce your buying power requirement. What would be the better solution would be simply just to pick an underlying that requires less buying power. For example, we have corn here. We have got an open position on corn, but that's fine. We'll just show you, another example. So let's just say we go to the 16 delta on the call side, 15 delta on the put side. As you can see in this instance, ZC or corn only requires $946 for an undefined risk position, keeping your deltas between about 15 and 20. And you can go to equities, and with equities basically the buying power requirement is going to be based on the size of the underlying. So underlyings that are for example Intel, if it's trading, let's say $20 or so, that's only going to use a couple $100 of buying power, as opposed to something like Netflix or Tesla that's going to use many thousands. So it pretty much comes down to the size of the underlying. With futures, your buying power requirement isn't just based on the size of the underlying, it's based on the absolute IV level as well. So that's one of the reasons why currencies don't use too much buying power, because they have pretty low IVs, as you can see here. Canadian dollar, euro, it's at 8%. Bonds as well typically don't require too much buying power, as you can see here, 1.9%, 4.3%. But yeah, you can just play with it, find some positions, but that's basically how you manage your money. That's how you, um, structure your portfolio. And if you would like to learn in more detail, again, the link will be in the description, but this time click on EDS Premium instead of the position sizing template. It's going to take you over to this page. Just get yourself signed up. Inside of EDS Premium, you will have access to one of our portfolios that will allow you to see the positions that we place, how we manage risk, how we make adjustments. Because although we will have, as we saw in this example, we're going to have a 90% win rate, 80-90% win rate. That does mean 10-20% of the time we will have losing trades. That's where managing or making adjustments comes into play. If you can take your losing trades and turn them into break evens, that's going to massively boost your profitability. And we show how to do that live in a live account with live trades. You can reverse engineer our adjustments, our positions, and study them, or you can just copy us. It's completely up to you. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. It's a private community, so if you do get stuck, you can speak directly with myself or with other like-minded individuals. And there's a 100% money-back guarantee. So once you have been through the full course, followed some of our trades, if after 6 months you are not profitable for whatever reason, then we'll work with you for free until you are, or you can just request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price used to be £1 a month. We've increased the price because our first wave of members was full. Now we're on our second wave of members. Once our second wave is full, we will be moving on to the third wave with a price increase as well. So take advantage while you can, whilst the price is so cheap. So you are rewarded for getting in early, basically. The aim of EDS Premium is we want to teach you the skill. We don't want to keep you dependent on us. Once you've learned it, you can take it with you for the rest of your life. No one can ever take it from you. It's a very powerful thing to know and to learn. And we aim to get you to the point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.